Hello, everyone. Now that tax season is over, I will have more time for sharing more insights with you as to what is happening in the markets. Now, before I get started, let me remind everyone I'm not an investment advisor and I'm not here to tell you what to buy, what to sell, although I do share some of the strategy and some of the research that I'm doing when I'm thinking about making my financial decisions. So I'm just going to share that information with you guys. And if you like it, do your own due diligence and see if that information might be of any help to you. So before I begin, let's start off with this morning, right? So this morning, when I woke up, I saw United Healthcare stocks down almost by 22%, I think at that time. And I was quite surprised. Now, the reason why I don't own United Health, but the reason why I was looking at it, because I was actually thinking about buying it. And I was thinking about buying it because, all the data I've been recently collecting is pointing towards recession. Now that might happen 2 months from now, that might happen 6 months from now, but all the signs are just starting to build up. So I was thinking, maybe I should adjust my portfolio and look into healthcare a little bit because, people still get sick. People still need to use medical services. People still need to use insurance. People still need to use utilities. These are some of the sectors that are typically safe during the down market. So that's why United Health was on my radar. And on top of that, it's been doing well actually for last month or so, while all the other stocks have been crashing. So those were a couple of reasons why I was thinking about buying it. But when I did the valuation on United Health, it was still almost $100 above the fair value for that company. And that was the reason why I did not really pull the trigger. And I'm so glad that I have a system that I follow that stops me from making some crazy mistakes. What you will probably see is whenever a stock falls, something as big as United Health, a lot of time people start gambling with that stock because they think, well, it cannot fall anymore. And they will start buying options. They will doing all kind of crazy strategies. But really, they don't really have a strategy. What they have is a gamble. They've been gambling for so long that they get in the habit of gambling every time they see an opportunity. And I don't blame them because that's how the market is. If you take a look at the app, they're designed to make it easy for you to gamble. You take a look at news. News is always making you either fearful or they make you greedy because they say like you're going to miss out on opportunity and stuff like that. So we naturally become that way. So anyhow, if you have already done your homework, if you have already done your valuation, and when something crazy happens, you kind of know whether you want to make that decision or not. Now, if that stock would have fell, let's say, by another $100, if it was like around $350 range, $370 range, I probably would have bought it. But it's still, I think last time I checked, was still sitting around $450. And to me, that is still overvalued. So I think there's a still possibility that this stock can go down another $50, maybe even $75. And that's why I didn't really get into that trade. But anyhow, that's how the morning started. Another point I want to remind everyone too is sometimes we think that we know what the financial markets are, but they are full of surprises. No matter how confident you are, no matter how much information you are, no matter how much data you have been collected, sometimes you'll get a surprise and it will just throw all your thesis away. That's why it's so important to be vigilant in market. That's why it's so important for you to not jump at every single opportunity. That's why you need to build your thesis over time. Because if you build the thesis over time, there's a less chance of you making a mistake. But anyhow, S&P 500 did well. I thought that, after a company like United Health, take a hit for almost 25%, S&P 500 going to take a hit as well, but that did not happen. As a matter of fact, Russell 2000 was up a little bit. So that was quite surprising. Usually when markets are bad, small caps take even a bigger hit. So you see, again, market is full of surprises. Then we had that interaction with Jerome Powell, where, Trump did not like his answers. Obviously, Jerome Powell said, look, I'm seeing that a lot of possibility of higher inflation for a longer period of time. If you guys remember just a month or so ago, they were saying that, hey, this is going to be temporary and it's going to adjust. But now they're saying, well, I don't think so. I think it's going to be more permanent. And I think Mr. Trump did not like that answer because if if the inflation going to be there and it's going to be there for a longer period of time, that takes any incentive Feds might have to reduce the interest rate. So he certainly didn't like that. And then he pointed out to what is happening with ECB, who are doing the rate cuts. And here we are, Jerome Powell, who is holding on to his stand and does not want to do the rate cut. Now, who is right, who is wrong? I don't want to get into that politics. But the point is, they both have a point, right? Donald Trump has an agenda. His agenda is to get these negotiations done. But these negotiations are not going to happen in next 2 weeks or a month. They're going to take time. They may take 90 days, might take 6 months. And in the meanwhile, market can fall apart. And if it fall apart, President Trump will be under pressure to make concession to these countries, which he doesn't want to do. So current Fed policy is actually making President Trump's job a little bit harder. So that is one problem. On the other hand, Feds have a reason to not make a move. Why? Because, if inflation is sticky, then that can only make things even worse if they do a rate cut. So they both have a point. So I don't really know who is right, who is wrong here, but it certainly creates a problem for us because all it does is it adds more pressure in the market. Like, for example, let's say if I want to talk in favor of Fed, Jerome Powell, right? Well, why did he have to say anything? He could have just make a light comment and not really talk about anything and just move on. But he talked. And it's not like he didn't know that President Trump not gonna like that. He knew that, and he talked anyway. So that's a problem. And then second part is President Trump is talking about having Jerome Powell resign, perhaps replace him, maybe terminate him if he can, all kind of statements like that. Well, then there's another problem, right? Because when we talk about the Feds, we're not talking about one person. It's not Jerome Powell himself. This is a committee of 18 members. So are you saying that all 18 members are in the Trump camp if he were to replace the chairperson? Would that happen? I don't think so. I don't think that's going to make a whole lot of difference. So that doesn't really play out either. So that's what happened today. But now let's get to the facts. What are some of the important numbers we need to pay attention to? Well, one of the numbers that I don't like is Philly Fed PMI. That fell by 39 points to negative 26.4. Now, this is a lowest since April 2023. So that doesn't really look too good. If we take a look at new orders, they also went down, negative 34.2. Now, this is worse since April 2020. So kind of gives you an idea that, people are slowing down. Whenever people stop placing orders, that means they're expecting sales to slow down. So again, another sign of recession. How about shipments and employment? Well, that also fell. They're also low, but so far we're not seeing major layoffs. So that is kind of looking good. But again, I think we're going to see that in another couple months or so here. So those numbers will start to show up, but they're just not there yet. Because we do know there are a lot of people who are unemployed now because of Dodge cuts, because of reduction in the government spending. And then on top of that, I'm feeling it in my own with my own clients. I'm seeing a lot of small businesses are starting to struggle. I'm seeing a lot of clients who are getting laid off. So I'm starting to feel that as well. But numbers are telling us otherwise. Initial jobless claims. Well, they dropped by 8,000. So we were expecting a little bit more, but now there are 215,000. So that's a good news for the time being. How about people who are already on the claims? Well, that dropped a little bit as well. So that's another good news, at least for the time being. But the truth is, I think the market is expecting that hiring is going to slow down. But we're not seeing any major layoffs that can point to a recession very, very soon. So that's why we have to be careful when we're playing the market. We can't just go completely in and out. We have to adjust. Yes, things are pointing to recession, but that doesn't mean we will have a recession. It is possible that Feds might change their mind. It is possible that Trump can, change his mind. Maybe negotiations with these countries might be successful. A lot can happen. Another major point I want to also talk about is treasuries. So there has been a lot of speculation. People have been saying, it's China selling the treasuries, or maybe the foreign countries selling the treasuries and all that. But the truth is, I think a lot of people, and even the governments, people are the one who are making these decisions. A lot of people are starting to realize that U.S. Treasury might not be the safest asset this time around. I think that's the simplest answer to this query. People are starting to realize, and it doesn't take a whole lot of people to come to that conclusion. And I think those people are going to take that money and diversify in other assets like gold. I'll make a separate video explaining my thesis on gold. If you are into commodities, to kind of give you a little bit more a better perspective onto it. But I think that's a real reason. I mean, people are starting to feel that. I mean, if you let me ask you, do you feel like buying treasuries right now, especially what happened earlier? I mean, is that what your thought process is? Most likely not. I think that's the simplest explanation of what's going on. People want to avoid exposure to possibly depreciation in dollar, and possibly United States getting into recession, and they want to hedge, and they're using something better than Treasury. So that's what's going on in the market. We'll talk more about that in our upcoming coaching class. So those of you guys who are not part of the coaching class, let me remind you guys, we do this every 2 weeks. So all of you who are part of that, we're going to discuss all of this subject matter in great detail. And we'll talk about specific strategies that I am using to navigate the current markets, as well as other coaches will share their strategies. So you kind of learn from a practical examples as to how we're doing things. I have a lot of financial books. I've read a lot of financial books. But seriously, I didn't really start learning finance until I start hanging around with people who were in finance. Otherwise, I was stuck with the generic advice: buy the dips, market always go up, don't worry about it, it's all cool, this and that. The truth is, if those things were really true, right, then why would we have all these market crashes? Why would we in this situation to begin with? Because everybody knows buy the dip. So we would have bought the dip. S&P 500 wouldn't have dropped. NASDAQ wouldn't have dropped. The truth of the matter is, we are overvalued. Even today, we are overvalued. And that's why markets are correcting. You can run away from it. You can hide out from it. You can close your ears. All of that is all good. But that's the reality right now. Markets do need to adjust. There needs to be a correction. That way we can have a healthy economy again. So I think whether we run into a recession today, 2 months down the road, 6 months down the road, I don't know. But we need to be prepared. And that's what we talk about in these coaching classes. So if you're interested in learning more about that, just reach out to me. I'll be happy to share more information with you. Till then, well, I'll see you next time.